Hello, Nasim Kadem here. I'm your host today for the NAB Federal Budget 2021 digital event for regional Australia and agribusiness customers. Thank you so much for joining us, and a big welcome to any of our viewers who joined us for our first session earlier this morning. Over the next hour, we'll be unpacking last night's federal budget, finding out just what it means for our businesses in regional Australia, including agribusinesses, and how it might help you move forward. We've already heard from several experts on the topic during our first session today, which focused on Metro Australia businesses. But now we're going to delve a bit deeper into what's in store for regional Australia and agribusiness with our panel of experts. Today we have for you NAB Executive, Regional and Agribusiness, Julie Rinsky, PwC Partner and Tax Specialist, Paul Abbey, JB Ware Chief Investment Officer, Sally Auld, and NAB Senior Agribusiness Economist, Finn Zabel. But first, I'd like to acknowledge the traditional owners of the land on which we meet today. I would also like to pay my respects to elders past, present and future. The past 12 months have been good to agri on the whole, due in large part to favourable weather conditions. Production is up and exports are predicted to rise significantly this financial year. At the same time, regional centres have sprung to life as people have chosen to move out of cities in response to lockdowns and working from home. There have also been some notable challenges. China trade tensions over the past 12 months have hurt several sectors. That said, many businesses have done a great job of sourcing alternative markets. Labour shortages are also an issue for farmers who rely on international backpackers. This has upped the need for automation. So first up, we're going to hear from NAB Senior Agribusiness Economist, Finn Zabel. He'll provide us with some expert commentary on the state of our agricultural sector and what Budget 2021 has in store for it. After Finn's presentation, we'll take you to our panel of experts before answering any questions you might have. Feel free to submit your questions via the question box on the right-hand side of your screen throughout the session. Finn, thanks so much for joining us today.
Thank you. And thank you to everybody listening in and watching today. I'm just going to make the understatement, I think, of the year and say it's been a pretty weird 18 months for all of us in Australia and, not least regional Australia, rural Australia and people on the land. We've had the sharpest recession, the biggest recession in 90 years, worst conditions since the Great Depression. We've had lockdowns, we've had border closures, we've got no migration. And now with this budget, we're seeing continuing stimulus and probably the biggest recovery any of us are ever likely to see in our lives. The turnaround from recession to growth has been really extraordinary, and that's really what underpins this budget. I'll give you a little example. The NAB monthly business survey has been running for yonks, and it's a really good indicator of how businesses are going in Australia. And we had the sharpest contraction ever last year, and now we see most of the key indicators in the NAB monthly business survey at or near record levels. That is an incredible turnaround. Business is booming. I travel around the country quite a lot. Now, in the last year, it's been largely via Zoom, but we're getting back out and about. Julie and I were up at Beef in Rocky last week, and I've been doing some in-person presentations, and the vibe now is, not just in regional areas, but particularly I think in regional areas, that things are not overheating, but things are booming. It's an incredible time for a lot of people. Now, a lot of people have done it particularly tough over this period, but for agriculture, because of seasonal conditions and demand factors, things have been great. For regional areas, people have moved to the country because they didn't want to be in a city in a lockdown. So it's been an extraordinary time. Now, last night, I wisely decided that I wouldn't be putting together a slide pack. I thought, 20 minutes, I'll just wing it. So wing it I am, and it might be a little bit disjointed. But what I'm going to start with is the broad overview. I don't want to go into great detail about the key budget figures on a headline level, largely because I didn't produce a presentation, so I'd have to remember those numbers. But let's start with the big picture. The big picture is this is a stimulatory budget. The deficit, 100 bill plus, that's a big number. more perhaps than people expected. The recovery has been much sharper than expected. Clearly what the government is trying to do here is to target a lower unemployment rate. They're not looking to withdraw that stimulus. We saw incredible stimulus over the last year at a federal level, a state level, and also a monetary policy level. What we're seeing here is a continuing stimulus. You're seeing deficits for an extended period of time. The objective is to get unemployment down and wage growth up. That is a departure from what the government, I think, previously had anticipated. But the broad sense is here, I think, that in a crisis that we've had, in a recovery which is, I suppose, a recovery which is fragile in many respects because it's contingent on not having any further coronavirus outbreaks in many ways. I mean, we just don't know what's going to happen there. It is prudent to keep stimulating the economy. So that's what we've seen at a broad level. We've seen big money for aged care. There's more cash for infrastructure, for mental health. There's a number of areas which have seen support in the budget. Just a couple of key budget things I wanted to touch on around how we go and how we get out of the mess that we've been in terms of some of the forecasts underpinning it. And I think these are really important. The first of which is budget expects the vaccine rollout to be largely done by the end of this year. The budget expects that there may be some limited outbreaks, and we're in Melbourne and we're chasing them now. And Sydney had that outbreak last week, but that those outbreaks will be contained, broadly speaking. But that the international border, that is migration, and this is really important, particularly for horticultural producers, won't open until about mid-2022. So that's longer, I think, than people had expected, and something that we really need to sort of think about, because net migration is now going backwards. That's sort of not normal. We've got very low population growth, and that feeds into things like labour shortages and challenges for certain rural industries. But I'll get into the rural and regional side now. And to set the scene for you, wow, what a year for agri. It has been wild. We pulled 33 and a bit million tonne of wheat off country last season. That is the biggest on record and more than double what happened the year before. Extraordinary circumstances. Eastern Young Cattle Indicator, which is key young cattle benchmark, last month broke records again, exceeded $9 a kilo. You've got this incredible combination of prices and production both being good. Now, I think panellists here who look at agriculture would I suspect, acknowledge that you often get one or the other, but generally not both together. So that's been a real support to the industry. For a lot of people in rural areas in Australia, and I think we have to be remarkably thankful about how well we've done against coronavirus so far, and how lucky we are to be able to sit in a studio together and have this conversation without having to wear a mask or without having to have a perspex screen or any of those things. For a lot of people in regional areas, this wasn't the big story of 2020 and 2021. The big story was cracking season, great prices, and happy days, with the exception of labour. So I think that's a really solid base for agriculture to build on in this country, and also for regional areas. You've got regional areas which experience some of the biggest population growth they've probably ever seen, because if you've got a town of 2,000 people and 20 people move in, or 30 people move in, or 40 people move in, there's not actually that many houses. So, small changes in population can have really big impacts to the dynamism of a town, and particularly some towns which have had population declines for many, many years. So that's a really positive sign, I think, and it's a really good ground to build on in budget 2021. So I'm going to get into some of the measures for agri specifically, and I'll talk more broadly about regional after that. Now, the first challenge not having a slide pack is to remember them. So I'm going to talk about three big ones. There's about $800 and a bit million for this, what's it called, Agriculture 2030. Now, the National Farmers Federation has had this objective for some years now, which is for the value of Australian agricultural production to exceed $100 billion by 2030. When they came out with it a few years back, I thought, gee, that's an ambitious target. I don't know if they're going to get that one. But now government has acknowledged it and is putting money towards it. So about half of that 100 mil is for a variety of biosecurity measures. They're all, a number of smaller packages. African swine fever, I think, is one that really stands out to me. There's a real risk there. That's getting out and about. Really very important that we keep that out of Australia, I think. So that's certainly very welcome. There's some other biosecurity and pest measures. And then the balance, around 400 mil of that, there was some soil health money. There was some export and trade support. There's some labour support. So This is a really interesting mindset change for government. They're explicitly targeting a number that the NFF has put out there. NFF obviously were very happy with that, given that they were the ones advocating for that. So that's, I think, a really interesting change there. Second one I want to talk about, and I know we're going to get to tax later in this, and I'm not a tax expert, so I can't get into the nitty-gritty, but this instant asset write-off, which last year was extended up to $150,000. Now that's sort of like big agricultural equipment money. That system, that has been extended 1 year to 30 June 2023. Now, I think it's probably an open question how much agricultural equipment people are going to buy. Yeah, we've had a great season. A lot of people have bought a lot of equipment. We've certainly seen that in the business, Julie, that people are really spending cash and improving their businesses. But I think that'll certainly be very welcome for agricultural producers and also regional businesses looking to expand. There is an open question about how much more of that's likely to come through, given that people have had a big opportunity to undertake that investment, and we'll just have to see how that goes. Something to flag on that front, and I think it's a big deal, is in global supply chains, we've got this semiconductor shortage at the moment. So a lot of people who'd been looking to buy a new header, for example, hadn't been able to, because you can't get the computer chips for it. They're in everything. Any people who wanted to buy a new four-wheel drive, $150,000 instant asset write-off gets you a pretty fancy 79 series Land Cruiser, but you've got to have the supply available. So extending that for another year might help with that if we think there's going to be a 6 to 12 month delay on some of those pieces of agricultural equipment and business equipment because of this semiconductor shortage. So that was certainly really welcome. There were some sort of regional fund changes, and there was some water infrastructure. It sort of moved around existing money. Not really a huge deal there. The other thing I think that's sort of worth mentioning, and I mentioned it earlier on in the presentation, really relates to what's happening with migration. Now, let's look at a grain producer, for example, or a cattle producer. These are not high. These are not high labour input industries. So if you run a cattle property or you run a grain operation, you might have a couple of employees, but you're generally not a huge employer. Now, when you look at a horticultural producer where you have to pick all the fruit, and that's very hard to automate, you have a packing shed. Now, that might be a bit easier to automate, but it will take time. You'll have a large number of employees. Those employees have largely come from overseas. The thing to think about, I think, here is that while there have been some moves around trying to incentivise local labour, we've got negative net migration, and we won't likely have a return to full migration for another 12 plus months. Now, what does this all mean for that sector of agriculture? Really, I think what it means is that labour shortages that have existed are probably likely to continue for the next 12 months. And that's something to think about for your business. So where does that leave us all for agriculture? My sense is for the next 12 to 18 months, clearly we've had a great season. A lot of people have got cash in the bank. Planting is now underway across Australia, well underway for the winter crop, and a large chunk of New South Wales and parts of Queensland have got great subsoil moisture. It's dried out a little bit in the southeast of the country, and that's certainly a little bit of a challenge. WA, for whatever reason, every season seems to just be able to create a big crop out of nothing. It's all sand over there. So happy days, I think, broadly speaking. Cattle prices are at record levels. That's incredible if you've held stock. It's a challenge if you haven't, right? If you're in Queensland, you're in Western Queensland, you destocked 2 years ago, you're now trying to rebuild your herd and you're buying back into this market, it's a little bit of a risk for you. Our house view around cattle prices, and I'll preface this by saying I've been consistently bearish rather than bullish on cattle, is that there's downside risk this year, and that's something to really think about. But having said that, if it keeps raining, the scope of the herd rebuild task is so substantial that's likely to underpin demand. The sheep game looks good. Wool prices have really, I think, surprised us on the upside. If you'd asked me this question a year ago when consumer spending was going through the floor and no one was spending any money on clothes, I said I'm a little bit worried about fibres. But here we are sitting in a stand together. I'm wearing a suit jacket that unfortunately, because of coronavirus-induced weight gain, no longer does up. So I might have to get another one of those. That's a wool price gain. Pretty good times there. I think also when you look at dairy, opening prices should be pretty reasonable. Horticultural prices have actually been, broadly speaking, very good. Labour is the challenge there primarily. This is looking at a 12-month period coming up now, which I think we should have every reason to be reasonably confident about. When I look at the challenges for agriculture, the things that really pop up in my mind, and I know I've mentioned it, 1, labour shortages, 2, seasonal conditions. It has dried out a little bit in parts of the southeast. Now we've seen some welcome rains, but It's going to be hard, let's face it, to get a season as good as the last one we've had, and we are going to have droughts in future. The budget does provide some ongoing money for drought assistance. Now, drought assistance is not something that we really have front in mind in the agricultural sector at the moment, but by the same token, we have to remember that some parts of Queensland are still very dry and are missed out on rain, and a decent chunk of the state's drought declared. There will be droughts again, there will be floods again, so that's always something to think about. Looking to the medium term for the agricultural sector, I think there's great opportunities, but also some really big challenges. Clearly, the great opportunity is in East Asia and Southeast Asia. Vaccines are rolling out, and the great news is that vaccines are very, very effective at preventing serious coronavirus infection. I know there's been a lot of talk about vaccines, but I don't think anyone expected a year ago that we'd have so many vaccines that are approved and working and being produced. As those vaccines roll out through East and Southeast Asia, countries like Japan and Korea, Vietnam, big export markets for us, China, there's going to be a move back to going to restaurants. People are going to be less scared about the virus. Normal life, I think, will return in a lot of these places. Now, what does that mean? It means good demand for Australian agricultural produce. People want high quality things when they dine out. That's certainly a good news story, something to think about. I can't help, economists, let's be honest, we've got two economists on the panel here and maybe three, where we tend to be sort of glum people by our nature, so it would be wrong of me not to point out some of the risks that we face. I think a key risk is going to be around what the EU and the US does vis-a-vis carbon tariffs on us. The EU scheme is coming in 2023. That's a hot issue for agriculture and I think needs to be considered. Moving beyond agriculture to regional Australia more broadly, clearly we've seen the biggest, I think, reversal in city versus regional I've seen in my lifetime, and that's been really welcome for regional areas. There is money in the budget for some regional development programs. There's more money for infrastructure. I think there's another 15 billion or so off the top of my head over 10 years for infrastructure. Some of that's going to go to cities, but a lot of it goes to regional highway upgrades and regional transport upgrades and so forth. A lot of regional areas haven't had population growth for a long time, so haven't seen the improvement in services, haven't seen the boost in services. Now these areas, all of a sudden, you can't get a builder because everybody wants to work from home and people have moved to these regional areas. So there's a lot of pressures there, I think. Does the budget remove those pressures around housing and transport and so forth? I don't think one budget can, and I don't think this was really an objective of this budget too, to be honest. I think, though, that there will be more of a consideration around regional living. Things like there was a suicide prevention strategy and mental health strategy in this budget. We know that farmers and people in regional areas, there's a real isolation there for a lot of people, and people have got to really look after their mental health, and I think that's something that really is welcome. Aged care, there's more money for aged care in this budget. I know I've spoken a lot about agriculture today, but consider this. If I go onto the ABS website and I look at the census and I type in any regional area in the country that you care to think about, and I look at the biggest employers in those areas, not agriculture, it's almost never agriculture, it's healthcare. Healthcare is almost universally the biggest single employer in regional areas in Australia. So more money for aged care is a welcome thing. Whether it goes far enough to address the concerns of the Royal Commission is not something I can get into, but certainly there's more cash there. Healthcare is going to be a bigger and bigger area as the population ages, and particularly in regional areas which have an ageing population, generally have an older population than city areas. So that's something to really think about. But that was the big picture that I really wanted to go through. I'm left, having read the budget last night and been up late, waking up this morning, and I suppose the vibe of it for me is there's a fair bit in here for agriculture and a bit in here for regional areas. If you want to think about the things that matter to you in regional Australia, I'd probably talk about three things. One, the extension of the instant asset write-off is probably good for businesses. They'll be happy to get that for another 1 year. The government's continued focus on stimulus means that they want to get the economy back up and running. There was a risk about pulling back stimulus too rapidly. That certainly hasn't seemed to have transpired. There's a lot of deficits on the way for some time to come. In the short term, that probably means that's supportive to the economy. And the third thing I'd really like to focus on is the question around how much of this shift to the regions has been a permanent shift. And we just don't know that yet. We don't know how many people will return to offices in what level. But if even part of that sticks, that means that demand on services in regional areas is going to be bigger than ever. And the infrastructure money's sort of got to flow out, and I think that's going to be a really important focus. So I will leave it there. We've got a panel discussion coming up, and anybody who wants to type in a question, we've got some questions coming, and hopefully we can get a few. Thank you.
Thanks for those insights, Finn, and you did a great job winging it. So we're now going to hear from our panel a bit more about what's in this federal government's latest budget. Julie, let's begin with you. So what actually grabbed your attention in last night's budget, and what were the highlights for regional Australia and agribusiness?
Well, first of all, thank you so much, and thanks everyone for tuning in today. And Finn, terrific summary. Finn and I do a lot of work together, and I just love the way that he does wing it, because that's what we do in regional Australia quite often, because we're authentic and we like to just cut to the chase. From my perspective, I'm excited to see the recognition of the importance of regional Australia and agriculture to the Australian economy. And if I look at the last 12 months, Finn calls it a wild ride. It was a really tough time. We had droughts, we had bushfires, we had floods, and then let's throw some coronavirus in there as well. And the way that regional Australia has rebounded is absolutely outstanding. It certainly helped when we got that wonderful thing, magical thing called rain, because that really did change, the whole, landscape for many of us. But I'm excited to see, the investment in health. I'm excited to see it in aged care, mental health in particular. Regional Australia really needs that. Infrastructure is important because, as Finn said, regional areas are growing, and I want them to get their sort of due share of some of this as well. We need good hospitals, we need good schooling, we need all of those things in regional Australia, and it makes it far more attractive. The thing I'm excited about is to see the optimism in agriculture at the moment, because we know that drives regional Australia. If a town has farmers spending money, which they do locally, then the town absolutely prospers. So, it's exciting. It's a budget of, I think of building or rebuilding. I wasn't expecting any more than that, but that consistent flow of funding is good.
And so what does the regional Australia need to support their further growth?
I think infrastructure for sure, because I am seeing lots of people, endeavour to move to regional Australia with all of the best of intent. But, housing is a real issue and employment is an issue. And it's bigger than just fruit pickers as well. There's hotels in some regional locations who can't open their rooms because they haven't got sufficient people to, service those rooms as well. So we've got to make it attractive. But if somebody wants to move to regional Australia, they need to be able to live somewhere. And housing is becoming a bit of an issue in those locations as well. So I'd love to see, I like the federal government investing in infrastructure. I'd love to see the local councils just treat it with a level of urgency and say, hey, we've got to do something a bit faster to make sure that we can attract people and we can give them good housing as well.
And you recently attended Beef Australia 2021, which there were some pre-budget announcements from that. Can you take us through some of those?
Yeah, well, they were, as Finn called out, the biodiversity or the biosecurity work and the continuing of the water and all of those things. But, Beef 21 was amazing, and anybody had the privilege of attending, and I was there all week and I was exhausted but invigorated as well. There's so much optimism across the whole sector, and it's because all of the commodities are doing well. I spent some time on some of the stands in terms of some of the the ag tech stands as well, and I was speaking to one gentleman who went thinking that he was hopeful that if he could get $100,000 in sales, he would have had a good week. He left there with $1 million in sales. And, that's the stuff that's really, really exciting.
So, Sally, what incentives are there for regional and agribusiness to diversify their risk?
So I think that speaks to sort of like a fundamental issue in agribusiness, which is, so much of that sector is leveraged to commodity prices, and we know that commodity prices have, big ups and downs, big swings. And as Finn told us, it's a really positive story at the moment. A lot of agricultural prices are very high. A lot of resource prices are very high. But the nature of this stuff is that doesn't always last forever. And so I guess that speaks to the idea, and it's no different from, how you think about running an investment portfolio, which is not to put all your eggs in one basket. And at JB Weir, we fundamentally believe in the principle of what we call strategic asset allocation, which is allocating capital across a range of assets in a portfolio. And all the sort of academic research on that tells us that, over the long run, if you get that part of the story right, that probably accounts for 80 or 90% of your returns over the long run. And I suspect it's probably, not dissimilar if you're thinking about, a portfolio of different agricultural assets, or some agricultural, some non-agricultural. So this whole idea of diversification of income stream, I think, is probably going to continue to be a really fundamental one. And, anyone that's been in the agricultural business for a long time knows that the good times are great, but they don't last forever. And so, part of being a sort of sensible, forward-thinking producer of agricultural goods is that, you put away and you save for, perhaps the next downswing in commodity prices.
And the sector's calling out for private investment. How open are private investors to investing in the sector?
Oh, definitely. I think so. I think fundamentally, what's going on in investment markets at the moment is people are looking around and saying, well, the Reserve Bank's telling us a story that it doesn't think it's going to be raising interest rates for the next couple of years. It's a similar story in the US. So cash rates everywhere are pretty close to zero. And that means that you get, in nominal terms, a very small return on your cash. In real terms, once we adjust for inflation, that return is negative. And so this is forcing investors, to effectively consider other investment options. And so for us at JB Weir, one of the biggest growth areas is what we call alternative assets. So, yes, we have cash, we have fixed income, we have equities, and then we have a whole spectrum of investments that we would call alternative. And these are a little bit different, and they tend to offer a higher return. Certainly, you might take a higher risk in going into those investments, but we're seeing huge demand for those, which tells me that, we have a pool of capital in Australia which is really looking for other investment opportunities. So I think in that sense, it's a really good time for a sector like agriculture, because some of the opportunities there, would definitely fall into the, what we would call sort of less familiar or alternative assets. And I think it would be a wonderful thing if we could sort of match up the supply of capital with the demand, and that would be super positive for the agricultural sector.
If I can just add to that, in terms of private investment and equity, there's a huge demand, and lots of investors are looking for agriculture in their portfolio, purely because of the the performance over the last 12 months. It just feels like a really, really positive approach. We're getting overseas super funds wanting to invest. There's a lot more activity there because it has been one of the strongest performing sectors.
And I think, along with the ups and downs of the economy and ups and downs of markets, increasingly investors are thinking longer term and thinking far more fundamentally about what are the sort of big thematic long-term stories that we can invest around. And agriculture, like i.e. feeding the world, is one of those. And I think in Australia, we're uniquely positioned to take advantage of that. So that speaks exactly to what you're seeing, Julie.
Yes.
We'll just jump in with one really quick point on this. I think there's a real sense, particularly in some country areas, but largely in city areas, that farming is old mate with the Kelpie and the Ute that's 25 years old or something, and it's all old school. And a lot of agricultural enterprises aren't like that now. We're talking about really sophisticated businesses with big risk management tasks and large portfolios. Farming has changed massively, and when I travel around the country and we talk about cattle prices, for example, we talk about this question around, well, what goes up must come down in commodity markets, all things being equal. A lot of people already thinking about, well, what's the downside risk for cattle prices? Because I think everyone knows that it's very high and it's got to come back at some point. And I think there is a broad sense that we need to be managing risk. So risk management within agricultural enterprises has changed massively from the old days where, look at grains, 40 years ago you could only really sell it to the AWB or for wool to the wool board. So there's been a huge diversification, I think, and a big focus on business management, which is making it less like the old school thing that we all think about it and more into a very sophisticated business sector.
And even if I think about regional Australia and I think about tourism and one of the things that is booming in regional is country pubs at the moment. People just sort of going and wanting to spend, the weekend in a country location, and, country pubs are really doing well at the moment.
I heard you're going camping out in regional Australia pretty soon.
I am. We are doing our bit for regional Australia in the upcoming school holidays. So,
great. Yeah. So Paul, did you see anything in the budget that might help our regional business from a tax perspective?
There's not a lot which is specifically regional. There's a couple of very small things about the tax exempt status of grants for floods and storms, but apart from that, nothing really specific. Probably the most significant thing is what's been mentioned, which is the instant asset write-off being extended for 12 months. So that is an attraction for people to get their spending in. They have to get the spending done, but they have to get the equipment installed and ready for use. And all of that has to be done by the end of the threshold time, which is now going to be 30 June 23. So there'll be some people who will be motivated by that. That change, though, is mostly triggered around the big projects where there's a long time scale to essentially work out your implications of the project, do the planning, do the buying, do the construction. So in the smaller projects where people can immediately get things up and running when it was the policy was announced last year, there might not be much happening in that area. The thing which is also associated with that is the loss carryback measure, which is particularly relevant if you're conducting your business in a corporate. So if you've got a corporate structure, you're a taxpayer in a corporate, and you've been a taxpayer in 1819 or 1920, so you've got franking credits which are related to paying tax in your corporate structure, then the loss carryback measure means that you can do the big capital expenditure, get the instant asset write-off, make a loss, probably from a tax perspective, even though you're not making a cash loss, in 22 or 23, carry that back to the earlier year and essentially view the earlier year as then a loss year, get the refund of the tax previously paid for that year. Now, one of the issues maybe in the regional communities is a lot of people don't necessarily conduct their businesses through corporate structures. A lot of people use partnerships, a lot of people are sole traders, and then you've also got people who are in trust structures. So that measure might not be particularly attractive for them. And again, for the bigger operations which have corporatised, there might be an opportunity there, but not maybe in the mid part of the sector where you don't have corporate vehicles being the way businesses are being conducted.
And Finn, you mentioned in your opening that the instant asset write-off was a huge success last year, but pretty much everyone's bought up their tractors and their equipment and so on. So do you think it's going to be as big a hit this year? Well,
the short answer is we just don't know. I think on one hand, and this is your typical economist answer, I'm going to give you on one hand, on the other hand, and then give you no answer. But, I think on one hand, we just had a great season and a lot of people have got cash in the bank. If it hadn't been for, it didn't really matter what happened with the instant asset write-off. People were going to spend money last year in Australian agriculture. But the instant asset write-off, certainly the feedback we've received has had a real impact, right? And people have bought a lot of equipment. Against that, it's been really hard to source a lot of products because of demand. You've got supply chain issues, and you've got this semiconductor issue. But let's just think about supply chain issues really briefly. Back in, when I say back in the old days, I mean 2 or 3 years ago, there used to be really good business moving grain for smaller producers out of Australia in 20-foot containers. Containerised grain, you could have a really interesting, sophisticated market strategy where you could just move a container and send it halfway across the world. Can't do that anymore. You can't get a container easily. It's really hard. Shipping costs have gone up very substantially for both bulk carriers and containerised shipping. And then coronavirus has thrown a whole spanner in the works. So it's been really hard to get product. So I think there's still plenty of people out there who are looking to buy and are looking to get new equipment and haven't been able to for whatever reason. They'd be very happy to have another 12 months of this instant asset write-off. Question is, would they have done it anyway? Maybe they would have. But the short answer is, I think we really don't know. And anyone who says, I know when this semiconductor shortage is going to end, I don't think they really do. It could be 6 months, could be 12 months. At some point, supply chains will free up, but they're pretty constrained right now.
Being the only non-economist on the panel, and maybe a little more positive, I'm excited by it. I'm really excited by it because I think it does, there has been, if you've wanted a Hilux ute, you've had to wait and wait and wait. And so that catch-up time will be great. When I looked at, just certainly the difference it made last year, irrigation was high, farm equipment was high, but so was coffee machines, sewing machines, a whole lot of other things. So I think it's one of those where I think some people may have been waiting to see how the year panned out, and they thought, let's just see, let's not get ahead of ourselves, etc. And then this might help them just, buy a little bit more time.
I mean, certainly this is, I've been at the bank 7 years, predominantly in agri role, and I don't know if you share this view, Julie, but this is as good as I've ever seen it.
Great.
So people have got cash. For a lot of people, it's time to expand their businesses. And I don't think it's being done because people think, the good time is going to be here forever. People are thinking, this is a good time. I can consolidate my operations, get more efficient, look at the labour question. You know, there's plenty of equipment that you can buy to reduce your labour reliance. You're getting quite high tech. Look at the way we do harvest grain, for example, much more computerised. So I think there is a big focus on investment. That's for sure.
On that labour equation, I mean, has there been any measures that will help around labour hire, to Paul or whoever else wants to answer?
Oh, look, I mean, I think at the margin you could say, you know, helping out on childcare might free up some participation, you know, probably predominantly by women. But, you know, that expanded measure, you know, doesn't help every family, but have a couple of kids in childcare, which, as I understand it, is really only 1 out of every 4 families. And there's a continuation of the wage subsidy for apprentices, so that could help as well. But I sort of feel like, you know, while this stuff is good, it doesn't go anywhere near sort of offsetting the drain in labour supply we've had because we've had closed borders. So probably doesn't really solve the problem anytime soon.
We did a little bit before COVID have some growth in older age participation, and we were getting better at female participation from admittedly a low base, and so hopefully we can sustain that through, and that will compensate a little bit of lack of immigration activity. But you probably wouldn't point at anything in this budget outside of the childcare for the old age participation, which is the other part of the participation story.
And I think the problem
where
we have is that, you know, when you look at the Bureau of Statistics labour force numbers, the participation rate is already at a record high. So, you know, I guess the question we have to ask is how many more people can we suck into the labour force?
Or keeping older people in the labour force for longer.
But here's a really interesting question I have in my mind. I don't think there's a really easy answer to it. On one hand, we've got these high participation rates. We've seen unemployment come down really rapidly. We've seen the government explicitly say, hey, we want unemployment below 5%. We've got these record high levels in business confidence and business conditions. You've got all of these anecdotal reports around labour shortages, and yet wage growth is at record lows or close to record lows. So something is not adding up in this system here. And now I'm an employee of NAB and happy to be an employee of NAB. Of course, I would like wage growth. But the reality is you look at the forecasts that NAB has and we're still expecting wage growth to be low for an extended period of time. So something has to give in this scenario. Either wages are going to go up because people are going to have more job opportunities. Now, probably going from NAB agribusiness economist to picking fruit and cans is going to be a tough transition, I'll grant you that. But you know, something has to change here. There is a contradiction between, on one hand, labour shortages, on the other, low wage growth. And I don't think we really know what the answer is going to be.
Sally, you mentioned the participation rate though, but isn't the point now we need to get more women participating in the workforce? And while there has been some announcement around childcare, it is only for the second child. So how much that in itself is it going to lift the participation of women, and what other policies might help, particularly for agribusiness?
Well, I think we know what policy works, and we saw it this time last year, which was free childcare. You know, because then there's absolutely no impediment to go back into the labour force. I mean, there might be issues around skill atrophy if you've been out of the labour force for, you know, 5 or 10 years, but, you know, those can be remedied. A lot of that happens on the job anyway. So, you know, you sort of feel like maybe that's a step in the right direction, but I think we sort of, you know, all experienced a world last year where it was like, wow, wouldn't this be amazing if it lasted forever? And I think that would go a long way to solving, you know, the female participation rate story in the country, given that we know, you know, females actually do, you know, most of the caring responsibilities for young children.
And that childcare cost also works often badly with the way the tax system works, in that you get to this hump where the combination of tax and the non-deductible childcare cost means that your effective tax rate for each additional hour of working starts to go up, and so you get this circumstance where a lot of women realise that to work 3 days a week is financially effective, to add a 4th day is a lot of time, but net money is not much, and then often the statistics show that the 5th day that is actually backwards. So unless you're doing the 5th day for skill acquisition, for a long-term perspective of getting a better job, then you don't work the 5th day and you probably don't work the 4th, and you're just working those 3 days. And so you've got this intersection of the childcare cost and then the structure of the tax system creating, and then the way family benefits work, creating this pressure point that you lose what you lose is you don't lose them working at all, you lose them working the additional days.
It's a definite problem, and I suspect that closer to the federal election we'll probably see more policies aimed at lifting women's participation. But we'll leave our panel discussion there for now so we can have some questions from the audience. If you've not done so already, you can please submit any questions that you have using the question box, which is located on the right-hand side of your screen. And in the meantime, we're going to have a very short break.
They're up at the crack of dawn, and they work until dark.
Sounds like it. We should burst into dance now, like moving.
They're mothers and fathers, sons and daughters. Together, they face the tough times and celebrate the good. Bound together by a love of what they do. They build together, innovate together, adapt and change together. Not just working the land, but working with it. Generations teaching one another how to seize opportunities and deal with loss. They might think they're ordinary, but we know they're far from it. For them, it's more than a job. It's a way of life. They do it together because together they grow.
Now.
So I see the first question for the panel is about population change in regional Australia. They say there needs to be a lot more unpacking, reduced immigration, return to family properties, early retirement. How do we address this?
Is this one for me, is it?
One for any
All
of
right,
you.
well, I'll get started and I'll say thanks very much for the question. There were several parts to it, but I'll start with the migration rate question. Australia has been a high migration country for many, many, many years. If you look at the proportion of the population in this country, which is born overseas, it's one of the highest, basically the highest in the Western world. Nearly a third of the population has been born overseas. More than half the population's parents were born overseas. My personal view is that that's a fantastic thing and that we should be remarkably proud of the way that we have done there. We have been a high population growth country. That's led to pressures predominantly in capital cities like Melbourne, where Melbourne's now a city of 5 million people. Regional areas haven't really seen a lot of population growth. Some regional towns have within 2 hours of a capital city, but a lot of them otherwise, once you get 4 hours out from Sydney or Melbourne or Brisbane, population hasn't really been rapidly increasing. So I think on the population growth side, my view is we need population growth back to support demand. There are clearly labour shortage issues, which are only going to be able to be remedied by having population growth return. And in any case, a lot of these regional areas haven't actually experienced this population growth. So what we have seen is the lowest population growth since World War II. But for regional areas, you've seen a lot of people moving to regional areas. So it's been this weird time where I live in Melbourne, and in Melbourne, things were just getting more and more people every year. Now people have moved to regional areas, and regional areas have seen a share of population growth. As to the question around family-owned properties, still a very large number of properties which are family-owned. There is increasing corporate ownership in agriculture. There have clearly been changes over the years, right? It's not what it used to be 50 years ago. I mean, dairy prices were regulated until 20 years ago. Wool prices there was a wool monopsonist, i.e. a buyer of all the wool, and the government ran that. Grain the same. Agriculture has changed in Australia. It's become more commercialised, but there's still great opportunities for family-owned businesses, and a lot of the businesses we bank. I speak to lots of people are family farmers and have their families been farming for in some cases over a century, and I expect that will continue for an extended period. I don't know if there were any other thoughts on that.
Oh, no, I mean, I think the issue going forward, I think that this is probably for regional Australia one of the big upsides of the COVID pandemic is that And one of the issues about moving to regional areas was it's a lovely quality of life, but you need to have a job to be able to go there. Now we've managed to disconnect those things. You don't have to have the job in the region. You can have the job in the city, but you can live in the region and do it. And I think that's been a fundamental shift, which I think, we're already seeing that dynamic happen. That will continue over time, and I think that'll be a sort of constant fundamental support for regional Australia over the next decade, which I think is a really good thing.
The real question I have in my mind is the working from home thing has been the biggest shift I reckon I've seen in my working life. How long will it continue and in what form will it continue? I think we don't know the answer to that yet. Alan Oster was on the panel before me looking at metro areas. He's my boss. I hadn't seen him in 14 months. So that's a big change. It was weird to see him. So in 14 months' time, will I have not seen him in that intervening period? I don't think it will be the same. And that will have an impact at the margin.
The next question is about the instant asset write-off and whether the scheme will continue to drive investment from regional businesses and farmers.
I might have a go at that one because I actually think it will, because whilst we've seen an enormous uptake to date, I do think there's still some people who just recovered from what had been a really tough 5 or 6 years leading up to it. They've started to consolidate before they've even thought about spending money, and they've just sort of said, look, hey, let's get through this year. We'd love a new XYZ, but right now let's just get through the year. So I think given that they have had a good year, that they've seen it extended, I think there will be some uptake. It's by no means a magic bullet, but it is a nice, helpful, certainly opportunity for people who were looking to do something, coming off a good year. There's lots and lots of cash sloshing around in the system right now, and I think people are sort of feeling far more optimistic than they were 12 months ago.
If we're to assume we're swinging toward a reinflationary economy, what are your views of our current position in the commodity cycle that we're currently finding ourselves in?
So I think that question really speaks to, do you believe we're at the beginning of a commodity super cycle, which is going to be an extended, multi-year cycle where we see an upswing in commodity prices, or do you think the way commodity prices are responding at the moment is a consequence of supply issues in some markets, like iron ore would be a great example, and also just generally where we are in the macro cycle, which is that we are at the beginning of a global economic expansion, which is being fueled by very loose monetary policy in most jurisdictions and increasingly very loose fiscal policy in most jurisdictions. So this is an early stage economic recovery, and you would expect to see commodity prices doing very well at that stage of the economic expansion. So I don't quite know, I haven't quite made up my mind on that topic. I'm sort of veering towards the latter, which is I think what we're seeing is really just a consequence of cyclical impulse and where we are in the cycle. And I think over time, some of those supply issues will start to resolve themselves, and that will probably mean that commodity prices will peak and start to come off. But to all intents and purposes, while some of the rises look pretty spectacular, this is what happens, when you have a sort of reasonably synchronised global economic expansion in its very early days.
And you look at what Commonwealth Treasury says around iron ore prices, and let's be honest, I don't think anyone last year was expecting iron ore to hit a record level of $220 US a tonne. That's extraordinary. The Treasury forecast in this budget for iron ore prices that it will return to its long run average of US $55 a tonne by I think mid-2022 or something. That's not far away. So to go from 200 plus to 55 in the period of 12 months, it's a big forecast, I think.
But there's a bit of a trick in that, because once upon a time we'd do the federal budget, and the way they'd price commodities for the purposes of the budget is they'd take the average of the last 4 weeks and they'd put that into the budget. And so when you were Treasurer Swan, what would happen is those numbers would go into the budget, they would never be achieved. And you'd always say, we'll be coming back to surplus next year, we never would. So what Treasury are now trying to do is to take a much longer view of a pricing cycle in regard to commodities, both iron ore and in regard to coal in particular, and get a more accurate outcome. It's then why they're conservative in doing that, because they think that the pricing cycle will show that. But as you say, the iron ore price is fantastic for tax collections, fantastic for corporate tax collections. I think we made, in the last year, we made an additional $8 billion in corporate tax collections thanks to the iron ore price. And if we sustain that out for a period of time, for every $10 that we get in additional iron ore prices for the next year, we'll collect another $1.3 billion in corporate tax. And so $170 over that period could be very good for the budget.
Oh, undoubtedly. But I mean, this question around, and I think the question was initially about inflation, and yeah, it's a really tough question, because you've got these question marks around, are we in a commodity price super cycle? Agricultural commodity prices, look at the grains complex. You know, that's globally really, really elevated. You're seeing massive moves in corn, soybeans, and also wheat. So clearly there's pressures here. There's this commodity super cycle. Will it continue? I don't know. You've got supply chain issues. I mentioned semiconductor shortage. Will that continue? Or maybe for 6 or 12 months. Those things are, obviously inflationary, but then we're not seeing it turn up in the data in Australia yet. And wage growth is low. So that's a tough one to pick. And the reason why we get so worried about inflation, well, there's a number of reasons, but one of them is the Reserve Bank of Australia is technically an inflation targeting reserve bank. Now, they've not seen the inflation levels, their 2 to 3% target band, for yonks. We haven't had an inflationary event basically in my lifetime. I'm 35 years old. And that's something we don't remember anymore. But if we now have said, all right, we've got huge central bank liquidity, fiscal liquidity sloshing around, Sally mentioned this, the global economy, well, maybe demand gets going. Then you've got these supply chain issues. Well, maybe we get some inflation. What does the central bank do about that? They raise interest rates to lower activity. So, that's a challenge. The RBA have said on the record, we're not going to raise the cash rate until 2024. 2024 is a fair way away. What happens in the meantime if we get inflation? I think that's the challenge.
Then
right?
I think they changed their mind.
Well, yeah, but we've all been wrong. I mean, I've been wrong about a million things, but I'm not the governor of the central, the Reserve Bank. And to be in that position and say, hey, we've actually issued the biggest piece of forward guidance ever, 3 years of zero rates or near zero rates, we're going to change that.
Yeah,
Big
and I
deal.
think that's, maybe we're getting a little bit off topic. It's not really agribusiness, but, I think this whole issue is really fundamental to, macroeconomic outlook, investment market outlook. And what I suspect will happen is that it's all very well for the RBA to give us nice calendar guidance and say, look, 2024 is the year we think we might be starting to hike rates. But they've also given us some outcomes-based guidance as well, which is that, we're not going to do it until we see inflation sustainably in the target band. So my sort of best guess would be, as we move through time, I think that calendar guidance might take on sort of less importance, and it's going to be a lot more about outcomes-based guidance. And we've seen a couple of central banks take a few tentative steps in that direction. They've done it in Canada, also the Bank of England. So I wouldn't be surprised, if the NAB survey is really telling us what's going on out there, then I think it's probably more likely than not that the RBA might have to consider a shift in that direction.
And we think about the RBA as being this sort of entity which can make all of its own decisions, but that's not really true either, because the exchange rate is so important, and agricultural producers will know this, that you don't want to have a dollar above parity. Now, our house view is 80 cents mid-year, 83 cents at the end of 2021, around where the Australian dollar's headed. But here's the challenge. If the Fed has to raise rates early, then there's going to be some pressures there, right?
Yeah, no, I mean, I think that forecast for the Aussie dollar, looks pretty spot on to me. I think the risks around the currency at the moment, given the support from policy, how strong the economy is relative to expectations, and the fact that we've done very well in managing the COVID situation. I mean, all those things, plus that fundamental anchor for the Aussie, which is commodity prices, they're all sort of pointing in the same direction. So I think the risk that the currency pops its head above 80 cents is probably the right way to think about it. But you're exactly right. As much as the RBA would like to say we're an independent central bank, they do it with one arm tied behind their back, and that's because, in the end, it's sort of the Fed that dictates what goes on in global central banking through currency markets.
I don't know if that answered your question at all, but certainly was an interesting discussion.
It looks like there's a question aimed at Paul here. How
Yes.
are asset write-downs managed within trusts?
Yeah, I hope I answer that question. I think it's about what happens with the instant asset write-off in a trust. And if you do have a big piece of capital expenditure in the year so that you get a full deduction for it, what you're going to do is move the trust into a loss. And we do have a regime in our tax system which allows trusts to carry forward losses and to use them in the future. Probably the one, if I was going to, it's not advice, I shouldn't give advice on on something like this, but if I was going to make one comment, be very careful of that regime, very complex. But that's how the system is meant to work.
As in you could fall into trouble with the ATO?
As in, no, as in the ability, if you have a trust and the trust is carrying forward a tax loss, the ability to do something to lose the benefit of that loss is very high, much higher than a company.
A question for whoever wants to answer. Will people wanting to buy a home in regional Australia get any benefit from this budget?
Well, I'll have a first try at it, but, my fellow panellists were probably better at it. I haven't seen anything that will, and I would have loved to have seen. I know WA does a scheme where, there's an incentive if you build a home and, there's additional incentives. I would like to start to see some of that flow out to regional Australia as well.
Sorry, I was just going to say there's two very small changes in the super field. One is the encouragement for people who are long-term empty nesters to sell out of the house and put the money into superannuation. The threshold to do that is now age 60, used to be 65. And then for the withdrawal to invest in housing for first home buyers, that's gone from 30 to 50, again from superannuation. So you've got two little things there, but that's all I'd point to.
Yeah, and I think you hit the nail on the head, Julie. I think this is all about housing supply in regional areas. So, as Finn was sort of alluding to, even if 20 or 40 people move to a small country town, that can have a huge impact on the demand for housing. And so, ultimately, I think you're exactly spot on to encourage local councils because this is all about land supply at the end of the day, and potentially, some incentives to build as well. But if we can get that moving, then I think, we really would have the ability to secure this sort of shift that's gone from the cities to regional Australia and make that a story that sustains.
But ultimately, I mean, we've all seen the price movements in capital cities. Well, the ones in regional areas are much bigger. And, we were talking before the panel about some of the agricultural land prices you've seen. Can't make more agricultural land in Victoria, for example. So with interest rates at these record low levels, it's really tough to see how, you can get downward pressure. It's a tough one. It's really a tough one.
This one looks like a question for Finn or maybe Julie. Given surplus cash, do you have an expectation how much the Farm Management Deposit Scheme will grow from 5.26 billion by June 30?
Don't have a specific answer on it off the top of my head. Apologies. It's clearly there's going to be some FMD activity. The reason why we have FMDs is so that you can manage the bad years and the good years. We've just had a fantastic year in agriculture for a lot of people, not for everyone, but for a lot of people. And you'd expect that there'd be more money going in. What the dollar figure is, I couldn't tell you off the top of my head.
And I'm of exactly the same view. I think there's a lot, you can put 800,000 away and get that, you can leave it there for a period of time and you can use it as your farm management deposit. But I anticipate it will go up, but I wouldn't have an idea of how much.
Okay, well, thank you so much for a wonderful discussion today. I've learnt a lot about agribusiness. And, it's interesting that despite labour shortages, despite less migrants coming, you all seem to have a very positive outlook for the future of the sector, which is great. So over to you now, Julie, just for your closing remarks on behalf of NAB, Regional and Agribusiness.
Oh, no, thank you. And thank you so much to my panellists, and thank you, Nazim, for a wonderful job corralling us today, because you could see that we could have chatted most of the day away. I just really want to say, thank you to everyone who's tuned in today. To our customers, we really appreciate the fact that you trust to partner with us. We don't take that for granted. To my team in Regional Australia, thank you for your passion for your communities and for Regional Australia. There's been some tough times. It's so nice to see, the buoyancy and the optimism. We know that Regional Australia is resilient, but they've been tested over the last few years. So thank you so much. I'd love to say, just reconfirm, you would have heard it from our CEO many a time, but we're very much open for business. We're keen to support you in any of your endeavours, whether they're diversified or regional, agri, tourism. Come and have a chat.
Remember to keep on top of what this budget means for your business, so you know the way forward. Make sure you check out NAB's federal budget coverage on its federal budget hub at nab.com.au/federal budget.
Agribusiness.